Gold has been the standout performing asset in global financial markets over the past 1 year. The yellow metal has made a stunning rise to all-time highs above $3,500 per ounce in the global market and rupees 1 lakh per 10 gram in India. In 2024, gold delivered 20% returns compared to the Nifty's 8.7% gain. And in 2025, it has seen the upward momentum continue. From about 78,000 rupees to 1 lakh, the price of gold has risen close to 30% in less than 4 months so far this year. In fact, going back to late July 2024, the gold price has moved up from around 70,000 levels per 10 gram. That's a rise of 43% in just 9 months. And if we go back a little further, the price has been moving up sharply since February 2024 from around 64,000 levels. That's a gain of about 56% in just 14 months. These are stunning gains for gold in a relatively short period of time. For long-term investors, the gains have been just as impressive. Over the last 5 years, the gold price has more than doubled, delivering a compounded annual growth rate (CAGR) of 16%. Even stock market investors will be happy with these kind of returns. So what explains the sharp run-up? Will gold continue to rise, or will it finally take a breather? To figure out the answer, we must first understand the factors that influence the price of gold. But first, please note that this video is for information purposes only. It's not a security recommendation and should not be treated as such. There is no opinion or view on any security covered herein. 1. Loss of trust in the US. To put it bluntly, US President Donald Trump's tariffs has raised the yellow metal's safe haven appeal. Gold has always been a safe haven asset. People flock to gold either when times are tough or when there is uncertainty in financial markets. However, no matter the level of uncertainty, investors never lost faith in the US-dominated global financial system. But things have changed now. Trump has followed through on his election promise to impose reciprocal tariffs. This decision has raised concerns of a global trade war. Sure, the tariffs have been paused to allow for negotiations, but the US tariffs are not only very high, but they are also broad-based. In the case of some countries, the tariffs were so high that it could potentially destroy trade relations. This has shaken confidence among international investors. The US was seen as a source of stability in volatile global markets, but now it is seen as the source of the volatility itself. The market had assumed that Trump was using tariffs as a negotiating tool and was not interested in causing serious economic pain. The thinking was that the tariff issue was more political than economic in nature. Wall Street never imagined that Trump, a businessman, would hurt the US economy. But Trump has refused to back down, at least initially, even in the face of a likely US recession. This spooked the US stock market. But the US government seems to be willing to ignore the stock market, at least in the short term. This resulted in a loss of trust in the US government. What was the result? Money started to flow out of the US. This is clearly seen in the recent decline in the US dollar. So many investors have taken defensive positions in the markets. This has involved selling stocks and moving the funds to safer assets like gold. The risk of inflation. Gold has always been an effective hedge against inflation throughout history. This is what we are seeing now. If US inflation were to rise in 2025, gold will rise in tandem. This risk has increased along with the possibility of trade wars. Trump's tariff policies are certain to have a negative effect on increasing the rate of inflation in the US, at least in the short term. Financial markets are extremely sensitive to any inflation-related news these days. The risk of inflation going up is supporting the gold price. US recession fears. The trade war between US and China, and potentially other nations if trade talks were to fail, has rattled global markets because the Trump administration seems determined to see it through. There was an implicit assumption in the markets that if the tariff policies caused an economic slowdown in the US, then Trump would ease up on the tariff pressure just to avoid a recession. But things are not so clear on this front right now. The final result will depend on the outcome of the trade talks. This is why fears of a recession in the US has increased recently. Gold typically does well when there is a fear of a recession in financial markets, and that is playing out right now. Wars. The ongoing tensions between India and Pakistan is just one of the many geopolitical flashpoints in the world. Gold has historically done well during such times. If a war were to break out, expect higher gold prices. Could the gold price continue to rise in 2025? The short answer is yes, it's likely. Sentiment in the market is extremely bullish on gold right now. The market momentum is very strong. Some investors have even considered getting out of stocks entirely just to buy and hold gold. However, we believe investors should carefully watch out for any potential changes to the underlying factors driving up the gold price. Avoid taking any extreme financial decisions. Could the price of gold fall? Yes, it can. How is that possible when the entire market is so bullish? Well, when everyone is positive on the price of any asset, the market often surprises by moving in the opposite direction. In that case, it would trigger losses for leveraged traders who are long on gold. The factors that can cause a fall in the gold price are the same as the ones that are responsible for its rise, only in reverse. Here they are. Trump lowers or cancels retaliatory tariffs on most countries after negotiations. Inflation in the US falls faster than expected. Peace returns to geopolitical hotspots like India, Pakistan, Middle East, and Ukraine. There are no other major flare ups in the world, like Taiwan, for example. Recession fears in the US fade away. Now, this does not mean that all the points above need to be fulfilled for the gold price to fall. Even some of these may be enough to take the wind out of the sails of the bulls. At Equitymaster, we believe in having 5 to 10% of one's portfolio in gold at all times. However, investors should not see gold as a potential substitute for any other asset. It makes sense to hold on to some precious metals in one's long-term portfolio, but it does not make sense to speculate on short-term price movements. While considering an investment in gold, have a time horizon well beyond 2025. Just because prices have gone up recently does not automatically make gold a great investment. Always do your due diligence before buying gold. Happy investing!